Hey everyone, Daniel Snyder from Seeking Alpha. Thank you so much for taking the time to check out this video here today. I'm excited. We're diving in with Stephen Cress all around dividend stocks. We're going to touch on some REIT names, talk on some other stock names. And this is obviously something that we know you're very passionate about. And we're going to cover some of the macroeconomic stuff going on right now that's setting up why dividends matter more than ever right now going into this year with what's been a crazy January. But before we dive in, let's go ahead and get a quick legal disclaimer out of the way. So stick with me for a second. We are not advising you personally concerning the nature, potential, value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions and Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. And with that out of the way, Stephen Cress, the man, the myth, the legend that I like to say, been in the industry for 30 years. You may know him already. You may love him already. If you don't, hopefully this will be a great intro for you. Background here for Stephen Cress is that he used to run a proprietary trading desk at Morgan Stanley on the quant side of things before he branched off and made Cress Capital Management as well as Cress Cap Investment Research, and later got acquired by Seeking Alpha. I believe it was around 2017, 2018. Steve can correct me on that. And he is the mastermind behind the quant system over here at Seeking Alpha, as well as the Alpha Pix portfolio and the Pro Quant portfolio and the dividend grades and the regrades, and the list goes on. And we're always bringing more analytical features to the site as well. So, Steve, did I do that pretty well? Did I get your background pretty?
Great job. I think you know me fairly well. So thank you very much for that
We've only been doing
kind
this for a few years
introduction.
now, so I should hopefully have it all buttoned up. But it's great to jump into conversation with you today. Thanks for taking the time to walk us through these stock picks. I'm excited to get into it.
Yeah, I'm excited as well. It's been a volatile January. We started off with a rally, then we had a decent little pull, and I think there's a lot of uncertainty going forward, and nothing better than uncertainty in the beginning stages of it. Have a couple of dividend stocks in your pocket, so pays to wait during that uncertainty, and dividend stocks help pave that way. So I think the timing is really good with this webinar today, Dave. I'm glad that you organized it. A little bit about what the presentation is going to cover is the 2026 stock market, a little bit about the pullback that we've seen and the rallies that we've seen, as I just highlighted, why we like using Quant to select stocks, and our top 10 dividend stocks for uncertain times in the days and weeks ahead. And not to say that the entire year will be uncertain, but there certainly will be points of uncertainty. And it's good to get ahead of that uncertainty with a couple of dividend stocks in your pocket. So, fear does create losses, and as I just highlighted, we like to get ahead of the uncertainty with a couple of the dividend stocks, or just as a general theme. It's always good to have a diversified portfolio, and if markets have been rallying, that's a great time to just add a few dividend stocks to it, to give yourself a little bit of a hedge if there is uncertainty. But I will say, and I'll point out here, when you're in the midst of that uncertainty, that's really good time to be looking at stocks with strong fundamentals. So, panic selling during market downturns can lead to financial setbacks. We have not seen that yet. We saw a little bit of a hair of that when our administration was talking about possibly a different number of outcomes or scenarios with Greenland. Markets got a little bit nervous about that, sold off. But since that point, it seems to have been smoothed out, and any wrinkles that were there seem to have been discussed with both Europe and the Trump administration, and perhaps there is a way forward to that, which will not lead to further uncertainty with Greenland. When this did happen, it was the S&P's largest single day drop since Liberation Day. We had a couple of other events. Japan's market has had some volatility, and that has instilled a little bit of nervousness in the markets. And now we're coming up later towards this week where we could see another government shutdown. The markets are kind of accustomed to government shutdowns. It's really the duration of the shutdowns that leads to markets turning over. Typically, I think a lot of investors have learned that they actually use the shutdowns as a buying opportunity, but we have to see the severity of this potential one coming up. And for the Democrats and the Republicans, how much are they going to dig in their heels? or are they going to come up with some kind of compromise and the government will not shut down? Only time will tell, but there's probably towards the end of this week, we'll find out. And of course, inflation continues to be a bit sticky and labor data continues to remain a little bit uncertain, all creating a volatile environment, allowing pullbacks in the market. So, with having said that, gold has been just continue to dominate the markets in terms of the best performance. It's had an incredible rally that you can see really started in the 2020 period and then 2021, 2022, 2024 saw a lot of central bank buying all over the world. Still saw above average central bank buying last year, but it looks like this year that central bank buying is coming back in force. So gold just continuing to really rally as a safe haven stock. And that is a telltale sign of what investors believe is happening in the markets going forward. So, other factors that support broad market rally, um, you could see the second wave of AI adoption. And in fact, I think Morgan Stanley was highlighting that today in 10 events that could happen for 2026. And it seemed that most of those 10 events were AI oriented. So broader sectors like healthcare, manufacturing, and logistics could benefit from AI integration going forward into this year. We're still really at the very, very beginning phases of it. There are individuals who say the markets are overvalued due to AI, but there are many, many other individuals and strategists and economists who say the efficiency is just starting and it really has to spread out to the broader market, broader set of small companies and medium-sized companies and individuals as well. And we've really just seen the very beginning stages of AI. We're also looking at the Fed pivoting for equilibrium management. There could be liquidity injections. Not so sure about the rate cutting, but that did transpire. And obviously, that did lead to markets rallying last year. At this point, it's more of a neutral standpoint from traders. They do not believe at this point that rates will be coming down during the next FOMC meeting. And that has to do with inflation still being a little bit sticky. And the economy could still do well. We have the corporate tax relief bill, the big, beautiful bill, which should help stimulate the economy. But that could also help stimulate inflation at the same time, which may lead to the Fed not making any further moves. So still uncertainty, but potential for market rallies as well.
Steve, it's
And
also worth mentioning investors are still keeping on the radar that we're going to have a new leader at the Fed here in, I believe, May of this year. So all eyes are still on that. So even though we're not pricing in a lot of cuts right now, that may change in the future.
it may change. And, even if we have a potential Fed chair who may be less hawkish, they'll still have to wait to see the data. So the data that we see now could be very different than the data that we see in May. And at that point, they'll have to make a decision. But probably, most individuals feel we're the new head at the Fed. They may have a greater uh, tendency or leniency towards letting rates decline, which, of course, our president would be very, very appreciative of, and many investors would probably be appreciative of that as well, because that is a good stimulus to get companies and the economy going, but at the risk of higher inflation. So we'll have to see how that pans out. The data will hopefully let us know. The data will tell the tale. And of course, I'm a very data-driven person, so I like looking at data. And right now, the data shows interest rate traders, 97% of interest rate traders believe that there will be no Fed cut at the upcoming January 28th meeting. And I think the indication is based on where the economic data is coming in and inflationary oriented data, it just shows that's a little bit too sticky and there probably will not be a continuation of the rate cuts anytime soon based on the way interest rate traders are voting. Of course, last year we had three cuts that occurred um, prior to December 11th, and that really, as I mentioned earlier, served as an impetus for the markets rallying. The FOMC statement framed the rate cuts as a response to rising downside risk to employment rather than a signal that inflation concerns had improved. So again, they were even at that point, inflation was still looking sticky, but rising unemployment, that was not a good look, very poor optics. So it helped inspire the Fed to take rates lower. The Fed is expected to keep rates the same as I mentioned this week. So it's important to look beyond the decisions, especially the past decisions that have been made, and focus really on the fundamentals of companies and not so much the macroeconomic data that we're seeing or what talking heads are saying on CNBC or Bloomberg. Uh, it's always best to really look at the fundamentals of a company when you make your investment decisions. So that's part of the reason why we like to use Quant. And as I mentioned, I am a very data-driven oriented person. So what is Quant? Well, we really employed Quant with fundamental analysis. So I, at one point, was a fundamental analysis. I worked in an equity research department, and that's where my training occurred on Wall Street. And when you look at the fundamentals of a company, we're really not that much different than analysts that work at Morgan Stanley or Goldman Sachs or Merrill Lynch. We're looking for key investment characteristics such as value, growth, and profitability, and we incorporate that into our quant model. So what does quant do? It uses this type of data and math and algorithms to identify companies that possess the investment traits that we like. So I mentioned there's three other traits, but at Seeking Alpha, we also add momentum and positive EPS revisions to that as well. So there are five core investment characteristics that we look at. And we take those investment characteristics and we combine it with the power of computer processing. So this will give us the ability to search through thousands and thousands of companies on a daily basis by going through their balance sheets, their income statements, their cash flow statements, and hundreds of financial metrics. And we score all those data points for companies relative to other companies in the sectors. And by scoring it, that helps us to decipher the strong companies from the weak companies, and we can actually even rank them. And we do that on a daily basis. So every morning between 4 a.m. and 6 a.m., we rerun all these data points, and it gives us the ability to put a fresh directional recommendation on a company every single day. So whether it be a strong buy or a strong sell or a hold, that's a fresh opinion. And I really like that approach. Having been an analyst, I know many research analysts will issue a research report every few months. And from my perspective, when you look at a research report that's dated 2 months ago, that's looking like looking at a new old newspaper article from 2 months ago and making an investment decision. So for me, it's paramount to have fresh data on a daily basis so I can look at a company and see how it compares to the sector. And that's what Quant enables us to do. And we have a pretty good track record. So this is looking at the past 5 years, and you can see over the last 5 years, if you took our quant strong buy recommendations and you created a portfolio and you rebalance that portfolio on a daily basis, and you compared it to Wall Street strong buys or just the S&P 500, you can see our quant strong buys have significantly outperformed both Wall Street analysts and the S&P 500. So over the last 5 years, the quant strong buys, by measuring it on a daily basis, are up 202% versus Wall Street analysts only up 18% for the same period, and the S&P 500 up 64% for the same period. And we actually, this is sort of this data takes all the trades from our Seeking Alpha system, but we actually have a back test that goes back prior to 2020. It actually goes all the way back to 2010. And every year since 2010 from our back test, and then from the simulated trades that you see here, we have outperformed the S&P 500 during that entire period. So really what this highlights is it's a quant system. This is an investable product that you're looking at. It's not an ETF or a mutual fund, but what we're doing is we're trying to showcase that our concept of looking at companies based on these five core investment characteristics works really well. And that's what this chart demonstrates.
Reminds me that
So
fundamentals matter, like we always say, Steve.
fundamentals definitely matter. The markets will often trade on sentiment and fear, but that always fades and the market always returns to fundamentals. And, if you are accustomed to that and you can not pay attention to the talking heads during these crisis moments and you take advantage of the market weakness and you focus on fundamentals, you will truly be rewarded for it. But right now we're trying to get ahead of the game because the market's still, at a nice relative high, even though there's been some volatility during the month of January. There's still plenty of time to get some of these dividend stocks into your portfolio for diversification. Should there be a correction at any point, this will help pay the way to wait through those corrections. So our first recommendation for a dividend stock is DiamondRock Hospitality, ticker symbol DRH. has a market cap of about 1.94 billion, and this is a REIT in the real estate sector. It ranks three out of 172 companies, and within its industry, which is hotel and resort REITs, it ranks 1 out of 14. And this is based on our Seeking Alpha Quant model. Year to date, the stock has had a return of 6.4%, which is actually greater than the S&P 500, and has a forward dividend yield of 3.8%. So this REIT has a fair amount of geographic diversity to it. It has 36 hotels like Marriott and Hilton brands concentrated in leisure destinations. The growth drivers include out-of-room revenue, catering, banquet facilities, and F&B. The company, over the last 3 years on a compounded annual growth rate, has had 103% AFFO growth, and it has versus the sector at 4.66%, and it has had 40% forward. It has a 40% forward AFFO payout ratio. If you look on the right-hand side here, you'll be able to see the factor grades, and you can see the valuation for the company is almost unchanged over the last 6 months. Growth has an A grade, which was the same as 6 months ago. Profitability has an A minus grade, momentum an A grade, and analyst upward revisions is an A plus, meaning it's far stronger than the sector. And what I'd like there is if you look at that A minus grade now versus 6 months ago is actually a B minus. So analysts increasingly are actually appreciating the positive aspects for this company, and they're revising their earnings estimates up for it. Its dividend safety grade is an A plus, which is just about the highest. It is in fact the highest dividend safety grade you can get, and the dividend growth grade is an A plus as well. Onto our next company, Valero Energy Corporation, ticker symbol VLO. This has a market cap of 57 billion. It is also a quant strong buy. Within the energy sector, ranks 6 out of 223 companies, and within its industry, within the energy sector, which is oil and gas refining and marketing, it ranks 2 out of 18. Over the last 52 weeks, it's had a 29% return, which for the energy sector is pretty good because energy has not been a great place to be until really the last couple of weeks. It's got a really nice dividend yield of about 2.57%. And it is a potential beneficiary of the Venezuelan heavy crude reserves and increased business opportunities. Valero manufactures, market, and sells petroleum-based fuels. It has a 20% EPS forward long-term growth rate, looking at a 3 to 5 year CAGR versus just 5% for the sector. So that's far higher than the industry. Cash from operations is 4.84 billion, which is a very big number. And its PEG ratio, which is one of my favorite valuation ratios, is 0.94, putting it at about a 42% discount to this sector. So if you look at the overall valuation grade, you can see on the right-hand side, it is a D plus. So it looks like overall the valuation is a little bit expensive compared to the sector with that D plus. But when you look at that PEG ratio and you just sort of zoom in on that particular valuation aspect, it does look attractive. And PEG is when you combine PE with growth together. So again, one of my favorite ratios. On a growth basis, it's a B minus, up from a C about 6 months ago. Profitability is a B plus. Momentum is a B plus, and analyst revisions are A versus 6 months ago where it was a B minus. So analysts increasingly liking this company. Our third dividend stock is Alpine Income Property Trust, ticker symbol PINE. This is another REIT. It has a quant strong buy, and within the real estate sector, it ranks 10 out of 172. And within its industry, which is considered diversified REITs, this ranks 1 out of 12. The year-to-date return on this is about 6%. So again, a little bit better than the overall market, but has a whopping forward dividend yield of 6.26%. This company, as I mentioned, it's a REIT. It has 128 net lease properties across 34 states, and that offer use of inflation protection through built-in rent escalations, and strategic selling also has occurred for various properties with lower growth potential. The AFFO growth rate on a 5 year historical CAGR basis is 11% versus the segment at 2.7%, and it has a 62% forward AFFO payout ratio as well. You can see if you look at the factor grades, very strong, excellent from a valuation standpoint at A minus, growth very strong as well. A an A, um, and the rest of the grades coming in pretty strong as well. So that would be Alpine Income Property Trust. Again, the forward yield on that, a whopping 6.26%. And our number four would be Host Hotels and Resort, ticker symbol HST. This is a fairly large REIT with a market cap of $13 billion. Again, a quant strong buy in the real estate sector, ranks 11 out of 172 REITs. And within its industry, which is hotel and resorts, it ranks 2 out of 14. Year-to-date return at 8%, again, nicely over the S&P 500 with a very large dividend yield of 5.08%. It is the world's largest publicly traded lodging REIT and one of the biggest luxury and upscale hotel owners in the world. Their properties include the Ritz-Carlton, Four Seasons, W, and Hilton brands. Geographically, it's a very diverse portfolio with a strong balance sheet. In terms of the AFFO growth, on the 3-year CAGR, this comes in at 56% versus the sector at 4.66%. And the forward AFFO payout ratio is 61%. If you look to the right, you'll see the factor grades. Valuation framework looks solid at B minus. The growth very strong at A minus. Profitability B plus. And here again, analysts really taking their numbers up for the company with an A minus revisions grade, which is again, these factor grades are sector relative, so they're comparing it to the rest of the REIT sector. So that means that A minus is showing that revisions are occurring at a higher pace for this stock than the rest of the sector. Dividend safety coming in at the highest grade possible, which is an A plus, and the dividend growth grade also at a B plus. And Daniel, our number 5 stock is not a REIT. This is a healthcare company, Bristol-Myers Squibb, ticker symbol BMY. Very, very big company. Market cap is 111 billion. It is a quant strong buy. As I mentioned, it's in the healthcare sector, and it's currently ranks 50 out of 970. So it's not the top stock, but within pharmaceuticals, it ranks 8 out of 179. Again, we're looking for companies here that pay a dividend. So we're not necessarily looking for the number 1, 2, or 3 stock within a sector. We want to make sure the stocks that we're highlighting here actually have dividends. The 6-month return on this stock is 16%, and the forward dividend yield, quite nice for a healthcare company, at 4.61%. And last year, it looks like they recently just inked a licensing deal last week with Janux for cancer therapy. Bristol-Myers is a biopharma company that also discovers and develops and delivers innovative medicines to overcome serious illnesses, including HIV and cancer, amongst many other drugs. It has a 64% EPS long-term growth rate for that 3 to 5-year CAGR. That is huge at 64% versus the rest of the healthcare sector at only 10%. Its net income margin is 13% versus the sector at 0.53, and the PEG is at 0.14, giving it a 93% discount to the sector on that valuation standpoint. And that is huge. Looks like the valuation compared to the sector is great anyway. If you look at the factor grades, you'll see it has an A plus for it. And Daniel will actually take us to the platform.
Yeah, let's
and
do
we'll
it.
bring up, yeah, we'll bring up the stock. So let me just go over here, duplicate that, and we're gonna put in BMY. So people can see firsthand what it looks like on the platform. So I've just taken us to the Seeking Alpha premium platform. And what you're looking at here at the top is a chart of the stock. You can see year to date, the stock is up 1.2%. And if we look at it over the last year, it's actually down 9%. Hence probably why the valuation framework is so attractive. So I'm going to click on valuation. And you can see a lot of A's here on a PE basis. It's only at 8.6 times versus the sector at 19 times. So it puts it at a 56% discount on a PE basis to the sector. So very, very cheap. If we were to look at on a PEG basis, as I mentioned earlier, it's a 92% discount to the sector. If we looked at EV to sales, it's a 20% discount to the sector. On a price to sales basis, 43% discount. So really excellent valuation framework for this company across most metrics. The one exception is price to book. And I don't really think that would play in as a significant factor for this company. So on a valuation basis, it looks great. Let's click on growth. So what we're going to see here is in terms of the revenue growth and EBITDA growth, we're looking at some red, and we can see that the growth rate is lower than the sector. So where does this company factor in? So what it's saying is the historical growth, which is the year-over-year growth, and even the forward growth rate over the next couple of years doesn't look great. But what does look good is the 3 to 5 year CAGR growth rate. So analysts are projecting out some of the growth for this company is not necessarily in the next year or two, but over a longer time period, 3 to 5 years out, they really see growth clicking in for the stock. And that 3 to 5 year growth CAGR, as I mentioned, it's a whopping 63% versus the sector at only 10%. This is a very important metric. So when we look at these with the overall factor grade that you see as A plus, you're probably saying to yourself, how do you get an A plus with so many of these other metrics in the red? And the reason is that when we use these metrics, we do not equal weight them. We place a higher weight on the metrics that tend to have a higher predictability in terms of stock price. So that EPS forward long-term growth metric, 3 to 5 year CAGR, happens to be one that has proven itself over time to be a very reliable metric. So it has a higher weight than many of these other metrics. So there are a couple other metrics that we don't disclose that also have a high weight too. It is a bit of a proprietary system, and that's how we get that A plus grade in there. So
Kind of
growth
makes me
overall.
wonder, Steve, kind of makes me wonder if this is one of those companies where, everybody's talking about AI and how it's going to be in the application layer. I mean, pharmaceuticals, we've been hearing about deals struck. There might be some interesting 3 to 5 years ahead for this company.
Absolutely. Like, with a lot of the AI, we saw it in the Magnificent Seven early on, but perfect, right along with lines that you're saying, really, as we go forward, this year, next year, the following years, we're going to see that spread out to industrial companies, healthcare companies, which will be incorporating AI for efficiency and for discovery. And much of that could be factored in here as well. Plus some of drugs that I think that are in the pipeline right now that could be panning out, not necessarily over the next year or two, but in a 3 to 5 year time frame, which are helping to take the company's long-term EPS growth rate up. And in terms of the dividend safety, I do want to highlight we have a separate card for stocks that have dividends. And the reason why we do that is on top, you can see factor grades and the quant. So these factor grades, we look at different metrics and we're looking for companies that will have capital appreciation, and those become our quant strong buys. When it comes to dividends, we actually, what's important is dividend safety. We want to make sure as we assess these companies, we want to give you the highest probability that they will not cut those dividends. And I'll actually break that down for you. So if we look at dividend grades beat the market, I will highlight from our back tests and the metrics that we pay attention to for dividend safety. You can see that 98% of dividend cuts were averted if you owned a stock with a dividend safety grade of B minus to A plus. So if you look at that, of course, nothing is guaranteed, but history does show if you focus on the metrics that we pay attention to, and I'll bring you to those metrics, a lot of dividend cuts could be averted if you look at dividend safety grades that rank between B minus and A plus. Conversely, we found that 70% of all stocks that had a dividend safety grade of F ended up cutting their dividend or taking it away entirely. And during the pandemic period, we found 41% of the stocks that had a dividend safety grade at the start of January 2023 cut their dividend within the next 12 calendar months, more precisely. So these dividend grades do work quite well. I'm going to take you back to it. So when I click on dividend safety, you can see here it is a B plus grade. And we're looking at a lot of different metrics from cash dividend payout ratio to dividend payout ratio to cash flow payout ratio. And you'll scroll down and you'll be able to see where there are poor metrics. So the company does have a high debt to equity ratio compared to the sector. So its total debt to equity is 274% versus the sector median, which is about 27%. So in this particular grade, it is an F. But in other grades, it's quite strong. Net income margin is an A minus at 12.5% versus a sector that is not even 1%. The return on common equity is 33%. Interesting enough, for the healthcare sector, it has a negative return on equity, So you can see there are many metrics that look strong. And one metric that I love, which is cash per share, it has a B plus. It's $7.72 cash per share versus the sector at $4.32. So there are a number of very reliable metrics that we look at that lead us to, lead to a dividend safety grade of B plus. And then if we look at the dividend growth grade, you can see some of the metrics are in line with the sector, some are a little bit worse than the sector, but then some important ones, such as degree of operating leverage, log of unadjusted stock price, return on net tangible assets. Those are fairly stronger grades than some of the other ones. And again, we have a couple proprietary metrics that we don't show, which leads that overall dividend growth grade. So that tells you a little bit about how the grades work. I'm going to bring us
Yeah, thanks
back
for
to
walking
our
us through that,
slideshow.
Steve. That was a nice little education lesson. We don't always share that. That was great.
Yeah. So we wrote an article last week, and in that article we listed 10 stocks. And believe it or not, three of the stocks have dropped from a strong buy to a hold, but hold does not mean sell. These companies still possess really good fundamentals. So I'm not shy to show you the list that we had. And 9 out of 10 names have generated positive returns within the last 52 weeks. Again, this is an uncertain environment that we might be going into. So we're ahead of that uncertainty. So it's always good to own a couple of dividend stocks going ahead of that uncertainty. So we feel very comfortable with this list. However, what I want to do highlight is, as I mentioned, there are three names here that have moved to hold. When we look at these recommendations, we want stocks that offer capital appreciation and income. But if you want to take a look at this list, you could and just go with the strong buys, and you want to expand upon that list and bring some other names in, it's really quite easy for you to do. You can go to the Seeking Alpha platform, and I'm going to show you how to do this.
Yeah, while you're jumping onto the platform real quick, I want to mention to anybody watching right now, I'm actually going to put the link to your dividend article that these tickers were on. I'm going to put that beneath the video. So after this video, if you want to check that out, you can see the original write-up as well.
Excellent. Thank you for that. So on the Seeking Alpha platform, if you go to the left-hand side, and you scroll all the way towards the bottom, you'll see Stock Screener. You can just click on Stock Screener, and immediately you will see in the Stock Screener these. You can create your own screens, or you can look at Seeking Alpha screens. If you're on Seeking Alpha screens and you look at the far right, you'll see top quant dividend stocks. You just click on that, and this is going to show you 10 strong buys, and it updates on a daily basis. So you actually see that there are some new names here in terms of the top 10, which weren't there before. So you could round out the list, you could expand your portfolio, you could take names away from that article and put your own stocks in. So quite easily to find our top quant dividend stocks by using that screener. So I'll take us back to the slideshow, Daniel, and beyond dividend stocks. So we do these webinars every once in a while. So I think we do maybe 2 or 3 dividend webinars. We just had our top 10 stocks for 2026, which we did in early January. So you can't always depend on getting your stock ideas from the webinars. You can get these stock ideas on your own. I created 2 products for Seeking Alpha, which help maintain a steady flow of strong buy recommendations. So the 2 products are the Pro Quant portfolio, which is part of our Pro platform, and then Alpha Picks. And it works quite easily. Alpha Picks is an excellent product if you want a flow of some ideas. It provides you with 2 of our best strong buys every month, and it's designed for long-term capital appreciation and individuals that like to invest for the long term. So again, you get 2 picks a month. I'd say on a monthly basis, there might be 2 to 3 trades. So a stock could come out, 2 will come in, and that gives you about 3 trades. There are criteria that we do have for these stocks. So for Alpha Picks, we're looking at companies that have a market cap above 500 million. We want the share price of the stocks to be above $10. We do send out trade alerts. So if a stock were to go to a sell, we would notify you immediately of that happening. And it has a lower portfolio turnover than our other product, which is the Pro Quant portfolio. So Pro Quant portfolio actually came out of a survey. We found from our Alpha Picks customers that they wanted more than 2 ideas a month. So with the Pro Quant portfolio, we have a fixed portfolio of 30 stocks, but it rebalances on a weekly basis. So as opposed to just getting two ideas a month, every week you may have on average 2 to 3 trades that occur. So that definitely increases the frequency of the trading. We also are a little bit less rigid with our parameters and criteria, where AlphaPix will focus primarily on stocks listed in the US. The Pro Quant portfolio looks at ADRs outside of the US as well as stocks that trade in the US. We also remove the market cap restriction for the Pro Quant portfolio. So it has a great amount of diversification for small, mid cap, and large companies with geographic representation as well. AlphaPix, as I mentioned, market cap has to be above 500 million. We're looking at, for the most part, at stocks just listed in the US or ADRs that are primarily listed in the US. And as you can see on the right-hand side, we've had great returns for both. AlphaPix, the 52-week return, it's up 34% versus the S&P up just 13% for the same period. And PQP, we actually just launched that about 6 months ago. And in the last 6 months, that has had a whopping return of 38% versus the S&P 500 at 12.74%. And I'll mention for PQP, since it's an equal weighted portfolio, when we compare it to the S&P, we're looking at the S&P on an equal weighted basis as opposed to a market cap weighted basis. And Daniel, I think that brings us to the end. Do you have any questions at all?
Not so much on the question front. Just want to encourage everybody to go check out AlphaPix and ProQuant Portfolio if you haven't already. I mean, obviously, the community there, the outperformance is there. You guys are so engaged in the chats over there as well, and making sure that you're getting back to everybody's questions. You get the full analysis right up. So, highly encourage everybody. You know, as Steve mentioned, we do these webinars from time to time, give you a few ideas, whether it's dividends or we have an upcoming AI webinar. But it's really cool when you get additional stock picks that dive into gold and all these other industries and sectors beyond what we just do in the webinars. So, highly encourage everybody to go check that out as well. Steve, thank you so much for the 5 picks here as well. Obviously, there's the list of the full 10 that you wrote up in the article that is linked below this video. Highly encourage you, everybody, jump over to that article if you want to read up on the other 5 names as well. And Steve, really just thank you for the time today. I know everybody here appreciates it. Everybody, go ahead, put this into at least a watch list, a Seeking Alpha portfolio here. Track them as well, as I love to do. If not, even, you know, if they're up for your portfolio, if it makes sense to you, that's on you. We're not here for investment advice, just great quality research from a data-driven approach. So everybody, thank you for taking the time to watch this video. Steve, thank you again, and we'll see you again here next month when we dive into another webinar.
Thank you, everybody. Appreciate your time.